Ameriprise Financial just reported a 55% return on equity for their second quarter. And, to put that massive figure into perspective for you, if you look at a traditional, well-run regional bank, they will typically throw a company-wide party if they manage to scrape together a 15% ROE.
Oh, absolutely. 15 is considered a massive win in that space.
Right. So when a wealth manager hits 55%, you really have to stop and ask, are you looking at a mathematical miracle or brilliant corporate engineering or, a trap hiding behind some really aggressive financial acrobatics?
Yeah, it immediately demands intense scrutiny because, numbers that are anomalous in the financial sector, they usually indicate one of two things. It's either a massive hidden risk leverage or you have a management team that has just fundamentally hacked their capital structure.
And that is exactly what we are putting under the microscope today.
Yeah.
We're looking at the Q2 2026 earnings transcript from Ameriprise, ticker symbol AMP, and we're really focusing on the insights from CEO Jim Cracciolo and CFO Walter Berman.
Right, because there's a lot to unpack there.
Definitely. And we are deploying our Talk Tickers format for this deep dive. So for you listening, that means fast data-forward analysis, zero Wall Street fluff, and highly opinionated, actionable takeaways for your retail portfolio. We are hunting for the actual structural mechanics driving these numbers.
And we're going to figure out if this stock is fundamentally sound or just, completely over-engineered.
Exactly. Because the surface level metrics, they look bulletproof, but the wealth management sector is currently dealing with some fierce crosscurrents.
Oh, fierce is an understatement. You have shifting interest rates, there's massive regulatory scrutiny on how firms manage client cash, and then, there's this recruiting more for financial advisors that is bordering on the absurd right now.
It really is. So we have to look at how Ameriprise is navigating that specific gauntlet. Okay, let's unpack this data drop because the top line beats came in just incredibly strong.
Very strong.
We are looking at nearly $5 billion in revenue, which is a 13% increase year over year. Adjusted operating earnings hit $1 billion, up 14%.
Right, which is solid, but
the metric that requires our immediate attention, the one that really jumps off the page, is the earnings per share. EPS saw a massive 22% jump to $11.07 per share.
Yeah, and that's the kicker, right? That EPS growth is just massively outpacing the actual revenue growth.
It's a huge gap. 13% revenue growth versus 22% EPS growth.
And that delta, that gap right there is the absolute fingerprint of heavy capital allocation at work.
Right. Meanwhile, total client assets hit a record $1.8 trillion. But I want to circle back to that 55% ROE because it was up from 51.5% a year ago.
Which is already incredibly high.
Exactly. And we know what ROE is, right? We know that a high return on equity is generally a strong signal of management efficiency. It's how well they use shareholder money to generate profit.
Yeah.
But, how are they sustaining 55% without taking on toxic levels of leverage?
Well, they're achieving it through this near-obsessive approach to shrinking their own equity base. Walter Berman was very clear on the call. Ameriprise is taking 91% of their operating earnings and returning it directly to shareholders.
Wow.
91%.
Yeah, that is not normal capital preservation.
No, not at all.
Yeah.
So they are essentially keeping just the absolute bare minimum required to keep the lights on and fund core operations and then dumping the rest straight back into the market?
Correct. Over the last 5 years, they returned $14 billion to shareholders, largely through these really aggressive share buybacks.
$14 billion, that's wild.
Right. In just the first half of this year, they retired 3.3 million shares, and the average purchase price was $467. Okay, wait, let's analyze that average purchase price of $459 in Q2 specifically. Because a lot of retail investors, they get really frustrated by buybacks when a stock is trading at near all-time highs.
Sure, they think it's a waste of capital.
Exactly. They see it as management indiscriminately buying the top just to juice the EPS numbers so they can hit their bonus targets.
Right. But if we look at their forward earnings multiples, that $459 level actually implies management believes the intrinsic value of the business is still significantly higher.
How so? Break down the mechanics of that for the listener.
Well, think of a share buyback mechanically, like water flowing into a set of buckets.
Okay.
The water is the company's free cash flow, and the buckets are the outstanding shares. If management uses some of that water to permanently smash, say, 10% of the bucket.
Right, taking those shares off the market.
Exactly. Then the remaining buckets fill up much faster and deeper, even if the total flow of water stays exactly the same. But here is the critical part, the part people miss. If you smash those buckets when they are fundamentally undervalued, you are creating massive permanent value for the remaining shareholders.
So Ameriprise isn't just blindly buying whatever the current price is.
No, not at all. They are looking at their 14% operating earnings growth and realizing that their own stock is the most asymmetric asset they could possibly buy right now.
Which creates that compounding effect we always talk about. You shrink the equity base, you grow the operating earnings, and suddenly a 55% ROE isn't some accounting trick. It's just a mathematical reality.
Exactly. It's just math. But, and this is a big but you can only execute that smashing the bucket strategy if the water pressure is actually increased.
Right, if the actual business is growing.
Yes. If the underlying business stalls out, buybacks just mask the decay, which means we really have to look at the actual engine of this company, which is the advisors.
And this is where we have to kind of squint at the numbers, because hitting a 55% ROE by shrinking the share count is one thing. But they also reported that their advisor productivity hit a brand new record.
Yeah, the average revenue per advisor is now $1.2 million.
Which is a 12% year-over-year increase across a fleet of over 10,000 advisors.
And importantly, Walter Berman noted on the call that this is part of a sustained trend. I mean, they have demonstrated 10% annual productivity growth per advisor over the last 5 years consistently.
Right. So mechanically, how are 10,000 advisors magically generating 12% more revenue this year? I mean, they aren't working 12% more hours.
Yeah.
They haven't found a 26-hour day.
No, and you eventually hit a hard human bottleneck in wealth management. There's only so much a person can do.
Exactly. An advisor can only review so many portfolios, sit through so many estate planning meetings, and, physically dial the phone so many times a day. So here's where it gets really interesting for me. CEO Jim Cracciolo spent a lot of time on this call pointing to their AI integration as the specific catalyst breaking that human bottleneck.
Yes, he did.
And unlike most CEOs right now who just kind of sprinkle the word AI into their transcripts to appease the algorithmic trading bots.
Yeah, just trying to get a bump in the stock price.
Exactly. Cracciolo brought highly specific metrics to the table. He claimed their AI suite is saving practices over 30 hours a week.
30 hours a week is massive.
It is, and he broke it down. Specifically, 10 to 20 hours from e-meeting automation, 5 to 10 hours from meeting summarization, and then another 2.5 hours from something he called Kapala premiums.
The time savings are incredible, but the mechanics of how they are achieving this in a highly regulated industry is the real story here.
See, I want to push on that, because anyone can use a generic large language model to summarize a transcript, right? But in wealth management, if an AI hallucinates a detail about a client's tax strategy or, misrepresents a guaranteed return in a meeting summary, the SEC and FINR will fine the firm into oblivion.
Oh, absolutely. It's a massive compliance risk.
Right. So how is Ameriprise deploying these tools without triggering a massive compliance nightmare?
Well, that is precisely why this isn't just some generic off-the-shelf integration like ChatGPT. When Jim mentions tools like Kapala premiums, we are talking about ring-fenced proprietary systems built on top of incredibly secure infrastructure.
Because FINRA compliance rules, particularly regarding client communications and record keeping, are practically draconian.
Exactly. If an AI summarizes a meeting, that summary becomes an official broker-dealer record.
So the AI has to be perfectly accurate, auditable, and immutable.
Right. And Ameriprise has spent the capital to build an architecture where the AI is constrained by strict compliance guardrails. It doesn't actually offer financial advice.
Okay, so what does it do?
It acts as a hyper-efficient administrative extraction tool. It essentially listens to the unstructured data of a client meeting, the life events discussed, the risk tolerance expressed, and it structures that data directly into the firm's CRM, pre-filling compliance forms, and drafting follow-up actions.
Okay, so it's fundamentally shifting the role of the advisor. Because if I am an advisor, I am no longer spending my Friday afternoons locked in my office doing data entry and trying to remember what a client said to me on Tuesday.
Exactly. The administrative friction is just gone.
Which triggers a massive psychological shift in the business model, doesn't it? I mean, wealth management clients, they do not pay 1% of their net worth for someone to just run Monte Carlo simulations on a spreadsheet.
No, they can get that for free from a robo-advisor.
Exactly. They pay for emotional security. They pay for a financial therapist who can talk them off the ledge during a market correction.
That's spot on. And by using AI to automate the math and all that administration, Ameriprise is allowing its advisors to spend nearly 100% of their time on relationship building and asset gathering.
They're essentially turning their advisors back into therapists.
Precisely. And that right there is how you drive average revenue per advisor up to $1.2 million. You completely remove the administrative ceiling.
And the runway here is still huge, right? Because Crispin Love from Piper Sandler, he asked about the adoption rate during the Q&A section of the call. And Cracciolo noted that out of their 10,000 advisors, only about 6,000 are fully utilizing these tools right now.
Which is such an important metric. It means there is a 40% latent capacity still sitting in their existing fleet.
Wow. Yeah, 40%.
Right. So as those remaining 4,000 advisors onboard the tech stack, that $1.2 million productivity metric has a clear structural path to keep climbing, completely independent of whatever the broader market conditions are doing.
But, let's actually talk about those market conditions, because that brings us to a massive structural risk in the wealth management sector right now. And it's one that Walter Berman spent a significant amount of time defending on the call.
You're talking about the core versus cash earnings mix.
Yes, the core versus cash mix.
This is arguably the most critical fundamental metric for anyone analyzing a wealth manager in 2026.
So Walter proudly stated that well over half, and he said it's trending towards 70% of their SOT. Advice and wealth management earnings are core earnings.
Right.
He noted core earnings grew in the low 30% range, while cash earnings were flat. For the retail investor listening right now who might not realize how their broker actually makes money off them, we really need to break down the mechanics of this cash sweep spread and why the SEC is currently breathing down the neck of the entire industry.
Yeah, we have to unpack this, because to understand why a 70% core ratio is a massive defensive moat, you have to understand the dirty secret of wealth management over the last few years.
Let's hear it.
Well, during the zero interest rate environment, cash was trash, right? But when rates spiked to 5% recently, uninvested cash sitting in client accounts suddenly became a goldmine for these firms.
Because the broker takes that idle cash, sweeps it into an affiliated bank, earns 5% from the Federal Reserve, but only pays the client, say, 0.4%.
Exactly. That difference is the spread, and it translates to pure, unadulterated profit for the firm. These are classified as cash earnings.
Right.
And over the last couple of years, several of Ameriprise's competitors actually masked underlying weakness in their real advisory businesses because they were making billions of dollars in passive income just skimming the yield off their clients' cash.
It's crazy when you think about it, but that model is currently facing a two-front war. First, you have the macro environment. If a Fed cuts rates, that 5% yield evaporates, the spread compresses, and those cash earnings fall off a cliff.
Yeah, that is the macro risk. But honestly, the behavioral and regulatory risks are even higher right now.
Oh, so.
Clients are no longer financially asleep at the wheel. They are actively cash sorting. They are looking at their monthly statements, seeing that they are only getting 0.4%. And they're demanding that their advisors move that cash into money market funds or high-yield CDs that actually pay 5%.
And Walter explicitly mentioned this on the call. He said they saw clients repositioning out of certificates into other offerings.
Right. And when clients do that, the firm loses that spread entirely. And furthermore, regulators are now heavily scrutinizing firms that default client cash into low-yielding sweep accounts, arguing that it violates their fiduciary duty to act in the client's best interest.
Because the firm is making money at the client's expense.
Exactly. So if your wealth management firm relies heavily on cash earnings right now, you are essentially sitting on a ticking time bomb.
Which brings us back to Walter Berman's defense. Ameriprise is insulated because 70% of their revenue is core. And these are the actual fee-based revenues for financial planning and the basis points charged on assets under management. It is transparent, it is recurring, and it is largely immune to whether the Fed raises or lowers rates.
It means Ameriprise is actually getting paid to do the job of wealth management rather than operating some shadow banking arbitrage scheme. So growing core earnings by over 30% is a signal of genuine organic business expansion.
Okay, I am going to push back on the safety of core earnings, though.
Sure, go ahead.
Because I understand it is better than relying on a fragile cash sweep spread. But if we are entering an environment where competitors are losing their cash sweep revenue, aren't those competitors going to desperately slash their core advisory fees just to win back market share?
I see where you're going.
Right, because Ameriprise is boasting a 29% aggregate margin right now.
Right.
That looks like a massive target on their back. So how defensible is that margin against a Vanguard-style fee compression price war?
Look, it is a very valid concern. Fee compression is sort of the eternal ghost haunting Wall Street, but this connects directly back to the AI productivity discussion we just had.
How so?
Well, think about why clients leave an advisor for a cheaper option. Usually it's because they don't feel they are getting enough personalized attention to justify that 1% fee.
Makes sense.
But if an Ameriprise advisor, who is supercharged by Copala, has the bandwidth to meet with a client 4 times a year instead of once, proactively adjust their tax strategy, and act as a dedicated financial therapist,
Then that fee becomes highly inelastic.
exactly. The client isn't really paying for the asset allocation. They are paying for the high-touch relationship. And a discount broker who's slashing fees just can't replicate that high-touch experience because their advisors are buried in administrative paperwork.
They just don't have the time.
Right. Ameriprise is using technology to elevate the perceived value of the human advisor, which practically inoculates their core fees against a race to the bottom.
Okay, so the core earnings are defensible, and the AI is driving the productivity. That all sounds great, but we cannot ignore the bleeding that was heavily scrutinized during the Q&A portion of this call.
No, we definitely have to address that.
There is a very real headwind here, and we need to talk about the Comerica outflow and this irrational recruiting environment that management was complaining about.
Yeah, the institutional outflows are the primary bearish data point from this entire transcript.
Management disclosed that $19 billion in client assets from Comerica is accelerating out the door by the end of the third quarter. That is a brutal hit.
It's a huge number.
And on top of that, Jim and Walter sounded genuinely frustrated by what they called a highly irrational recruiting environment. They claimed competitors are writing massive upfront checks with 8-year paybacks just to steal advisors away.
And, from a corporate finance perspective, an 8-year payback on an advisor transition deal is extraordinarily aggressive. It's bordering on reckless.
Let's break down the mechanics of an 8-year payback for the listener. Because to me, this sounds like a desperate NFL franchise signing a 32-year-old running back to a fully guaranteed 8-year contract.
That's a great analogy.
It gives you a great headline on draft day, right? But it completely destroys your salary cap down the road.
That is structurally very similar. Because when a competitor recruits an advisor from Ameriprise, they don't just, ask nicely. They offer a transition package.
Right.
Historically, that might be a signing bonus equivalent to 1 or 1.5 times the advisor's trailing 12 months of revenue. And the recruiting firm expects to recoup that bonus over 3 or 4 years through the revenue the advisor brings in.
But Walter is saying competitors are now offering deals so massive that it will take the recruiting firm 8 years of perfect execution just to break even on the upfront cash they handed out.
Correct. And think about the compounding risks embedded in that timeline. What if the broader market crashes in year 3 and the advisor's assets under management get cut in half?
Their revenue drops, so the payback takes even longer.
Exactly. Or what if the advisor decides to retire in year 5? Or what if a subset of their clients just refuse to transfer their accounts to the new firm? The recruiting firm has already laid out the cash and they're holding all the bag risks.
So why are they doing it? I mean, if the math is that dangerous, why are competitors voluntarily taking on that massive risk?
Because they're chasing a vanity metric. It's called net new assets, or NNA.
Okay, NNA.
Wall Street analysts absolutely love NNA. It looks great on a quarterly earnings slide to show you brought in $5 billion of fresh assets. It proves, quote unquote, growth.
But Jim Cracciolo called this out specifically. He said, and I'm pulling the exact quote from the transcript here, NNA might be good if it truly translates into real profitability on a consistent basis with strong margins. If it doesn't, then what are you paying for? It's like the eyeballs on the internet back in 2000.
That is a very calculated reference to the dot-com bubble. He is equating his competitors' recruiting strategies to buying stock in Pets.com just because the website had high traffic, completely ignoring the fact that they were losing money on every single transaction.
Wow. He is literally saying his competitors are buying unprofitable assets just to look busy.
Yes, he is. And Walter Berman emphasized that Ameriprise evaluates the facts and circumstances of every single deal to assess the trade-offs between sustained profitability versus flows and the associated risk.
Right.
They are actively choosing to let advisors walk rather than destroy their own 29% margin by matching an irrational 8-year payback offer.
It requires an immense amount of discipline for a management team to intentionally shrink their asset flows in the short term just to protect long-term margins.
Right.
I feel like most executives will cave to the pressure of the quarterly earnings cycle.
It is the ultimate test of capital allocation discipline. Ameriprise is betting that the advisors who stay are doing so because they value the tech stack, the culture, and the AI tools more than a short-term cash grab.
And Jim mentioned that recruits who do join Ameriprise often complain that the firms they left were like 5 years behind technologically and lacked basic responsiveness.
So their thesis is basically, let the competitors overpay for mercenary advisors, let them blow up their balance sheets, and in 5 years, Ameriprise will be sitting on a fortress of high-margin, tech-enabled practices.
Exactly. But look, that discipline is much easier to maintain when you have a massive catalyst waiting in the wings to offset the short-term pain.
Absolutely.
Which brings us to the Huntington Bank onboarding. Because whenever an analyst tried to corner them on the $19 billion Comerica loss, management immediately pivoted to the Huntington deal. Let's look at the mechanics of this, because Ameriprise operates a specific division called AFIG, the Ameriprise Financial Institutions Group.
Right.
This is where they essentially act as the outsourced wealth management backbone for regional banks. Explain how that works.
Well, banks like Huntington have millions of retail customers, right? But they often lack the proprietary technology, the compliance infrastructure, or the high-end advisory talent to run a top-tier wealth management division in-house. It is incredibly expensive to build that from scratch.
Yeah, makes sense.
So they partner with a firm like Ameriprise. Ameriprise provides the platform, the technology, and the investment products, and they share the economics with the bank.
And the numbers on this Huntington deal completely dwarf the Comerica outflow. I mean, the Comerica exit is pulling $19 billion out, but Huntington is bringing 260 advisors and $28 billion of client assets onto the platform, starting in Q4 of this year and rolling into early 2027.
That is a net positive swing of $9 billion in institutional assets. But there is a very specific accounting nuance that Walter noted on the call that retail investors need to understand here.
What was that?
Even though the physical assets will take time to transition throughout late 2026 and early 2027, Ameriprise will begin benefiting from the economics of the full book starting in the fourth quarter.
Wait, how does that work? If the assets haven't moved yet, how are they collecting revenue on them?
It comes down to how these transition contracts are structured. Once the integration hits a certain operational milestone, which Walter indicated happens in Q4, the revenue sharing agreement goes live.
Oh, wow.
Yeah, it is a massive locked-in injection of high-quality core earnings that is completely insulated from the day-to-day fluctuations of the recruiting wars.
And Jim even hinted that the AFIG pipeline is still hot. They are winning other institutional deals that haven't even been fully announced yet. It proves that despite Comerica leaving, which, let's be honest, could have just been a strategic decision by Comerica to try bringing things in-house, the Ameriprise institutional platform is still highly sought after.
It is a massive validation of their enterprise tech stack, without a doubt.
Okay, so the top line is secured by Huntington. But let's look at the expense side of the forward guidance, because this is where the math usually falls apart for companies undergoing heavy technological transformation.
Yeah, tech isn't cheap.
Right. And Walter stated they expect general and administrative expenses to only increase in the mid-single-digit range for the full year. How is that functionally possible? We just spent half this deep dive detailing their massive rollout of proprietary AI tools, e-meeting automation, and new banking products. Usually, when a financial firm rebuilds its tech stack, CapEx and G&A expenses explode.
It goes back to a strategy they call transformation for growth. They are not just layering new technology on top of old, bloated legacy systems. They're aggressively decommissioning legacy architecture.
Ah, I see.
Yeah, Jim specifically called out the completion of their back office transformation in the asset management division, which wraps up in the third quarter.
So they are finding areas to ruthlessly cut administrative bloat, and they are taking the savings from those operational cuts to directly fund the new AI investments.
It is essentially self-funded innovation. By simplifying the middle and back office operations, they free up the capital to invest in the front office AI tools. This is exactly why their G&A expenses aren't spiraling out of control. It takes incredibly tight operational management to execute a tech pivot without destroying your operating margins.
Which protects that 29% margin we talked about earlier.
Exactly.
And that disciplined management leads directly to the final and perhaps most important piece of their forward guidance, the liquidity fortress.
Oh, this is the ultimate safety net for the retail investor holding this stock.
Walter Berman laid out the capital position. They have an excess capital buffer of $2.1 billion and an additional $2.8 billion of available liquidity sitting directly at the holding company level.
That's a massive war chest.
It is, and he made a very deliberate comment to the analysts. He said, and I quote, "We are positioned well whether the environment remains risk on or we see a pivot to risk off."
You know, when a CFO goes out of their way to explicitly mention a risk-off pivot during an earnings call, they are sending a very clear, heavily coded message to the institutional short sellers.
Let's decode that for the listener. A risk-on environment is what we've largely been experiencing, right? Mm-hmm. Markets are up, asset values are swelling, and clients are feeling wealthy and greedy.
Right. And in that environment, Ameriprise collects massive core fees on appreciating assets and steadily buys back their stock.
But a risk-off environment is the nightmare scenario for a wealth manager. It implies a macroeconomic shock, a recession, or a massive market correction.
Yep. Asset values plummet, core fees drop proportionally, clients panic and pull assets into cash, and the company's stock price usually gets hammered alongside the broader market.
But Walter's essentially saying, bring it on. Why?
Because of that $2.8 billion in holding company liquidity. If a risk-off event occurs and Ameriprise's stock price takes a sympathy dive with the rest of the financial sector, they have $2.8 billion of dry powder ready to instantly deploy. They can aggressively accelerate their share buyback program, scooping up millions of their own shares at a massive discount.
Which goes right back to your water and buckets analogy from earlier. If the market artificially depresses the price of the buckets, Ameriprise can smash significantly more buckets with the same amount of water, turbocharging their EPS and ROE the moment the market recovers.
Exactly. It creates a synthetic floor under the stock price. The buybacks will continue regardless of the macroeconomic weather, and they have the cash pile to prove it. They are completely insulated from a liquidity crisis.
Okay, we have dug deep into the mechanics here. We have mapped out the 55% ROE driven by aggressive, opportunistic buybacks. We've analyzed the proprietary AI tools, turning advisors into highly efficient financial therapists.
We covered a lot of ground.
We did. We've stress tested the 70% core earnings moat against SEC scrutiny and fee compression. We've broken down the corporate finance risks of the irrational recruiting wars, and we've validated the Huntington Bank catalyst and their $2.8 billion liquidity fortress. So it is time to synthesize this data. Put on your Talk Tickers hat. What is the definitive, actionable bottom line for the retail investor listening to this deep dive?
The verdict here is a heavily convicted bullish signal.
A strong bullish stance. Okay. Give me the playbook for someone holding the stock versus someone looking to enter.
For current holders of AMP, your thesis is entirely intact and structurally compounding. You own a piece of a business that is actively returning 91% of its operating earnings directly to you.
That's a great place to be.
It is. The management team is executing a masterclass in capital allocation. They're refusing to chase unprofitable vanity metrics like NNA just to appease short-term analysts. They are self-funding a massive technological advantage that is driving record advisor productivity, and they're doing it while maintaining a highly defensible 29% margin based on actual advisory work, not regulatory risk-heavy cash sweeps.
Right.
So if you hold this stock, you let the $2.8 billion liquidity buffer protect your downside, and you let management continue to ruthlessly shrink the share count.
And what about the prospective buyer? The investor looking at the stock today, who might be spooked by that $19 billion Comerica headline.
For the prospective buyer, the anxiety around the Comerica outflow is actually creating your entry window.
Oh, really?
Yeah, the broader market often trades on short-term headlines, and institutional outflows look scary on a Bloomberg terminal. But our analysis shows that the Comerica loss is a temporary, isolated event that is going to be completely neutralized and overshadowed by the $28 billion Huntington Bank onboarding in Q4.
So use the BIP.
Exactly. You have a window right now to buy into a company that is acting like the only disciplined adult in a room full of irrational competitors who are blowing up their balance sheets with 8-year payback deals. Ameriprise is offering a rare combination of structural downside protection and tech-enabled upside leverage.
Hide the discipline, hold for the compounding buybacks, and completely ignore the short-term noise of the recruiting wars. That is a clear, data-backed talk tickers takeaway.
I think the numbers speak for themselves.
They really do. But before we close out this deep dive, I know you have a habit of pulling on a single thread from these transcripts to look at where an entire industry might be heading.
I do because, analyzing the micromechanics of a company like Ameriprise often exposes the fault lines of tectonic shifts happening across all of Wall Street.
I love that. Let's hear it.
Well, the discussion around Copala and AI productivity raises a profoundly uncomfortable question for the entire wealth management sector.
Uncomfortable how?
We talked extensively about how Ameriprise is using AI to give their advisors 30 hours of their week back. Right now, in 2026, the technology acts as a hyper-competent administrative assistant. It handles compliance, drafts the notes, and structures the data. It enables the human advisor to be the therapist.
Right. It elevates the human.
But technology never stops at the administrative level. It climbs the cognitive ladder.
Okay, where is this going?
Well, if the AI is already ingesting every detail of a client's life, optimizing their tax loss harvesting and structuring their estate planning data, how long until the algorithm itself is better at the actual financial therapy than the human?
Wait, are you suggesting the human advisor gets entirely disintermediated, like replaced?
I am asking if we are approaching a tipping point where wealth management transitions from a human bottlenecked relationship business into a fully scalable, tech-leveraged SaaS model. Software as a service.
That's a wild thought.
Think about it. If an AI avatar trained on decades of behavioral finance data can detect the micro expressions of panic in a client's voice during a market crash and respond with perfectly calibrated, parenthetic, and mathematically optimal advice, why does the client need to pay 1% to the human middleman?
That flips the entire power dynamic of Wall Street upside down, because historically, the advisor held the power because they owned the client relationship. If they left a firm, the assets walked out the door with them.
Right.
That is exactly why competitors are offering those desperate 8-year payback deals today.
Precisely. But if the algorithm becomes the primary driver of value, the client's loyalty shifts from the human's Rolodex to the firm's server rack. The firm that builds the most empathetic, comprehensive AI architecture effectively owns the client forever.
And the human advisor goes from being a highly paid rainmaker to being a localized customer service rep for the algorithm.
Exactly.
Wow. If Ameriprise's proprietary tools like Copala continue to evolve at this pace, they might not just be boosting advisor productivity. They might be laying the groundwork to completely absorb the advisor's intrinsic value into the corporate balance sheet.
And if that happens, a 55% ROE will look quaint compared to the margins of a fully automated SaaS-driven wealth management monopoly.
Well, on that slightly existential note for financial advisors currently enjoying their AI-generated free time, we're going to wrap up this deep dive. The mechanics of the Q2 transcript show a company operating with extreme discipline in a very chaotic environment. Keep a close eye on the Q4 Huntington transition, watch that core earnings ratio, and we will see you on the next deep dive.